Fed is expected to announce a highly anticipated interest rate cut for the first time this year and in the first time since 2024. Happy to be joined by CSUB Associate Professor of Economics, Dr. Richard Gerhardt, joining us now to break it all down. Tell me, Richard, how can this impact home buyers in the near and long-term future?
Sure. So this actually benefits home buyers. It's going to reduce the mortgage interest rate pretty significantly. So you could look, maybe see mortgage rates approach 6%. They've been recently as high as 7.5%. So you're going to be able to see home buyers buy bigger and buy better.
The rumors are that the rates will be cut by maybe 0.5%. 0.25%. It may not seem like much, but can that still create a big impact?
Absolutely. So it basically does two things. It's going to incentivize companies to start construction projects, retail, all those sorts of things. But it's also going to allow consumers to buy more on credit cards, which is buy those durable goods, furniture, fridges, cars, those sorts of things. So it could have a very stimulative impact for our local economy.
Locally, what kind of impacts can it have right here in Kern County, though?
Sure. So we're going to start to see some new construction pop up just because it helps new construction because they're able to finance loans more easily, get equipment. But we're also going to see pretty significant increases in home buying activity, which is important for this area because we're trying to attract residents from Los Angeles and the Bay Area to take advantage of our lower home prices. So we could actually see population and economic growth, which would be fantastic.
So you'd say with these incoming rate cuts on its way, now would be a good time to maybe consider buying a home if you're a first-time home buyer.
Absolutely. Now is a perfect time to buy a home. It's also a perfect time to maybe invest in home improvement projects, decks, pools, those sorts of things.
You mentioned credit card debt is at a record high. How can credit card holders use the cut to possibly pay down their debts going forward?
Absolutely. So one of the benefits is now you're paying less interest payments. And so what you should do is you should pay the exact same amount you've been paying these past several months, which was probably the minimum payment, but you're going to be paying down more towards principal. So don't reduce your payment. Keep it the same. You'll be paying off your debt much quicker.
And how can people use this to maximize their savings going forward?
So unfortunately, this is actually probably going to hurt savers a little bit because you're not going to get as high rates on your savings accounts or bonds. So savers are actually going to be hurt a little bit, but most people are actually net debtors. They have credit card debt. So this benefits them.
Let's talk about these interest rates one more time. Why do they keep fluctuating? What is the Fed trying to do with raising interest rates, lowering interest rates? Why can't they just be low all the time? Yeah,
so the Fed has a dual mandate. They have to combat high inflation. They also want to combat high unemployment. And there's this fundamental trade-off between the two. If you lower interest rates, you spur economic activity. You increase economic growth, typically in the labor market. Well, unfortunately, higher economic activity means higher prices and higher inflation. So you don't want to keep interest rates low because then economic activity gets a little too hot. You start seeing inflation like we saw in 2021, 2022, which is 9%, which really hurts low-income Americans.
A recent CNBC survey showed many economists actually believe that could lead to higher inflation and weaker growth, these rate interest cuts. What do you say about that?
Absolutely. So one of the important things about the Federal Reserve is it maintains independence, and it has since 1913. And if you look historically, the last time politicians have gotten involved in monetary policy, which is what the Fed does, was the stagflation in the late 1970s, 1980s, where we had no economic growth and inflation above 12%. So we have to be very careful about lowering rates too fast because we are worried about stagflation. We're worried about anemic economic growth with high prices. You can't solve your way out of that problem, and it kind of has to happen naturally, and that can take years.
CSUB Associate Professor of Economics, Dr. Richard Gerhardt, joining us talking about the shifting tides of interest rates as the Fed looks to lower those rates in the near future. Doctor, thank you so much for joining me.
Thank you for having me.
Yes. All right, stick with us. We'll have more 17 News at Sunrise on this Wednesday morning coming up after the break.